Hello everyone, I'm happy to share with you just a video reviewing our retail shopping center investment. We've got a really exciting opportunity here. We currently have access through a repeat operating partner to a limited number of shares in two shopping centers in California. Each property was acquired in 2018, and we've been personally invested in one of them since then and very pleased with the performance. So let's go ahead and dive in. Okay, we have been investing in shopping centers for a little over 6 years now, and I want to share a quick update on the asset class with you. We've all heard it. The media continues to tell us that retail is dying and Amazon and e-commerce are taking over. And it's no surprise, Amazon continues to grow and do very well. We also keep hearing reports about all the closures of malls and large department stores. And the result is that right now there's really a lot of fear in the marketplace around retail today. And this is presenting a very interesting opportunity that we've been tracking for some time now. And more about that in just a minute. Let's quickly take a look at cap rates. As many of you are aware, we're really long in this cycle. Most asset classes have seen cap rate compression, causing margins to get squeezed. And what you can see outlined here is that the retail shopping center sector has actually seen recent growth in cap rates. And the fear in the marketplace has really created a buying opportunity. And shopping centers are currently on sale. Now, we don't anticipate this trend to last very long. It's really only a matter of time before investors who are chasing yield jump into the asset class. So we believe that now is a great time to take advantage of these recent trends. As Warren Buffett's taught us, to be fearful when others are greedy and to be greedy when others are fearful. Yeah, this quote's great, and I think it has a pretty good correlation to our thesis on retail today. Okay, now the fear that's in the marketplace has masked a lot of the reality. Today, e-commerce still represents less than 10% of retail sales in the US. So retail is not dead. It is evolving, and we do need to be careful. As I mentioned, big department stores and malls are a dying breed, and we are not investing in them. Today, there remains a consistent and growing demand for certain types of retailers and tenants. And we're really focusing on shopping centers that are highly resistant to the internet, to Amazon and e-commerce. And we're looking for a diversified tenant mix that provides daily needs, grocery, restaurant, and services. And grocery is a great example. You can see two photos on the screen here. These are grocery anchor tenants at each of our properties. And I want to share a quick quote from a recent survey. 87% of consumers prefer to buy perishable items in store where they can determine freshness. And this is a key reason why in-store shopping dominates the grocery category. Another important point, many brick and mortar retailers are growing, not contracting. I think it's important to note that and take a look at which retailers continue to do well. And a great example is Ross Stores. You can see a picture of one of the Ross stores here. This is at our shopping center in Orangevale, California, right outside of Sacramento. But Ross is a public company with over 1,400 stores. And last year they opened 98 new stores. And here's another quick quote I want to share. I think it really applies quite well. Forbes Real Estate Council recently mentioned the retail landscape is changing, but brick and mortar storefronts aren't going anywhere. Competition-driven retailers are finding innovative ways to internet-proof their operations. All right. Lastly, I want to share just some important, unique characteristics on shopping center investments. For those of you who may not have been investing in them for quite some time, or maybe this is your first time, many retail tenants are on triple net leases, where, of course, they're responsible for the rent, but also they're responsible for expenses, including property taxes, and insurance, to name a few. Retail tenants have long leases with built-in rent increases. And the asset class tends to have relatively low operating expense ratios, another feature we find very attractive. Now, the result is oftentimes an investment that provides a very attractive risk-adjusted return with stability and predictable cash flow and upside. Here's a short clip from one of the properties I recently visited. Hi everyone, Mark Curry here, coming to you today from Orangevale, California. I'm just outside of the capital, Sacramento, just doing some final due diligence on a stable cash flowing retail shopping center investment. And I want to take a moment to share with you a little bit about this property and what we look for in retail shopping centers today. So this shopping center sits on about 15 acres. It has over 160,000 rentable square feet, which is divided into 31 different rentable spaces. Now, this property is already over 90% occupied and performing quite well. But one thing I want to add is really in today's market, it's critical for us to take a very close look at the tenant mix. We're looking for diversification, and we're looking for tenants that are highly resistant to Amazon and e-commerce. And this property really provides a great example of that. Okay, let's review the properties in this investment. The first shopping center, which you just saw a clip of, is located in Orangevale, California, which is a suburb outside of the state capital, Sacramento. And the property is Cable Park, which was acquired in 2018 for 15% below its appraised value, which is a really great start to having equity at the beginning of an investment. And the property is really well located. It receives a tremendous amount of exposure with traffic counts exceeding 70,000 cars per day. And as we noted, it's already 90% leased and occupied. In 2017 and 2018, Cable Park went through a large redevelopment. Over $5 million was spent on the property to split and divide 60,000 square feet of space. The end result is we have 3 new anchor tenants: Goodwill, Grocery Outlet, and Ross Stores, all of which are on long-term leases through 2029. You know, the property is also the home to many long-term tenants, including the Orangevale Post Office, been there since 2002, Taco Bell since the early 90s, Denny's Restaurant since the 90s, and CVS since the early 80s, actually, as well. Okay, now there's an attractive value add plan here, which is already underway. We are in negotiations with Starbucks to build a drive-through coffee shop on the property in the area highlighted here in yellow. Now, to be conservative, this value add measure has not been added to the projections. But should it go through, it will provide a significant increase to net operating income and the property value. So we're really excited that this is already in the works here. Okay, let's review the second property in the portfolio. Lakewood Shopping Center is located in Windsor, California, about 65 miles from San Francisco in wine country. Lakewood was also acquired in 2018 at about 16% below its appraised value, and it's also the home to many long-term tenants, and it's currently 95% occupied. Now, Lakewood is anchored by Raley's Grocery. They've been a tenant at the property since 1980, and recently they invested $7 million into the property. They did a complete renovation in 2018, and they extended their lease until 2032. The property is beautiful. It's very similar to a Whole Foods. Now, also at Lakewood Shopping Center, we have Kelly Moore Paints and Wells Fargo Bank, both of which are leased through 2029. There's also the Town of Windsor Post Office located at the shopping center too. So if you're looking for a complete rental with a lot more detail, go ahead and download our investment summary. We've got all the details there. Okay, now Lakewood Shopping Center also has an attractive value add play. We are in process right now of replacing the existing 11,000 square foot gym tenant you can see here highlighted in yellow. Now their rental rate is over 50% below market rates. So the plan is actually to split the space into two and release at market rates. Now, this would have a substantial impact on the overall performance of the property. And most recent update, we already have now an executed letters of intent from two new tenants at higher than projected rental rates. So really excited about this. It's really increasing that this is opportunity is going to go through, and the likelihood of this growth coming to fruition. So more about that in due time, but very strong value add play here as well. Okay, let's summarize the financial projections. We have a projected investor average annual ROI of 13 to 16%. Annual cash flows beginning in year one are 5 to 7%, and those are going to grow to about 8% by year four. The investment term is 4 to 6 years. IRR is 12 to 14%. We have a minimum investment amount of $50,000. And distributions and reporting will be done quarterly, beginning at the end of the second quarter of 2020. Okay, so really excited about this opportunity. A lot of positive features. If you are interested in learning more, don't hesitate to reach out with any questions. You can just email me directly. My email's on the screen here. We have a verbal commitment deadline of March 19th, and funding is due April 3rd. Thank you for your time today, and I'll talk to you soon.